Morgan Stanley's Betsy Graseck says there are more reasons to own bank stocks. She is a Bloomberg best based on her bank stock recommendations. She is decidedly bullish on banks, and she is with us here today on the Inside Track. Wonderful to have you, Betsy. You are a bull on banks, but let's be clear about this. Based on what I've read and what I've seen of your research, this is not a growth story as far as you're concerned. It's about effectively balance sheet improvement and regulatory certainty. Am I correct?
That's fair. That's a very fair assessment. In this uncertain environment, you want to have either growth or yield, and we expect that the banks will be delivering yield over the course of the next 12 months.
Okay. It all comes down to the U.S. consumer. Not that the U.S. consumer is getting that much healthier, but the quality of the underlying credit that's on these balance sheets is improving. There is a lot of skepticism about the U.S. consumer. I think we need to go into some detail about this, or at least you need to explain to people how this works, because they look at unemployment trending close to 10% and say there's just no way that bank balance sheets can improve to the degree that on that basis they're a buy right now. Sure,
that's a fair question. And I think the key thing is, what's the rate of change? Is unemployment stable? Obviously, declining unemployment would be an even better backdrop for bank stocks. But stable unemployment is better, less bad than rising unemployment. And when you're a bank and you make a loan to somebody and they unfortunately lose their job, you write them off once.
If we were to think about this in the context of valuations, you look at the BKX, the bank index right now, and you compare it to where it was, say, in early March, and it's at more or less the same level. But back in early March, we had strong growth. We had expectations of declining unemployment to a degree. We had very strong trading results. Now we've got the most dismal quarter for trading since the depths of the financial crisis. We've got deteriorating expectations for GDP growth, and we have stubbornly high unemployment. How do we justify, how do we reconcile that?
Right. Well, I think what's going on is a little bit of a pause in the rate of change of the improvement. And at this stage, we've got, as you indicated, bank stock valuations roughly where they were, in the beginning of March. In fact, for some of my stocks, though, we're below. And some of our top picks, like Bank of America, which is on our best ideas list at Morgan Stanley, is at one of the lows that it's been throughout this year. Now, you might say, well, gee, why are you long that name? Why are you sticking with that name? And in a nutshell, it's two things. It's improving credit, and it's a return of capital that we're expecting over the course of the next 12 months.
A lot of people say Bank of America has not outlined enough of a strategy when it comes to doing things differently. Brian Moynihan didn't have that much new to say the other day. Do you feel as though staying the course, managing the business, getting the things right that Brian says he's going to get right are enough, with the prospect of an improvement in consumer credit and the likelihood that all this excess capital is going to find its way back to shareholders?
Yeah, I'd say two things. I think, one, there's more going on than what they're letting to in a very public forum. I think that there's a distinct strategy within each of the organizations within Bank of America to be improving on the expense ratio side, to be improving on the efficiency side, and to be delivering more value to their customers. A note that we put out recently after meeting with the management team at Bank of America outlines our views very clearly. We do think that this organization is going to be getting its return on equity up from where it is today at 5% to 13% over the course of the next several years. And the stock today is reflecting that 5% ROE. The market is not looking forward on the stock. We are.
Betsy, let's talk about the second half of your thesis, regulatory certainty. Mario Draghi, the chairman of the Financial Stability Board, the governor of the Bank of Italy, has an op-ed in today's Financial Times in which he calls for a greater penalty, effectively, for what we refer to as systemically important institutions, the big banks. He says there should be equity capital over and above the Basel minimums. There should be some debt convertible into stock on a contingency basis, and that the bondholders effectively need to share the pain with the stockholders. This is going to affect the prospects for some of your big picks.
Sure,
Bank of America,
absolutely.
JP Morgan, Wells Fargo, they're all, for the most part, maybe Wells Fargo less so, they're all pretty important institutions. This hasn't yet been factored in entirely. There is still some uncertainty there. How do you expect it to shake out over the next year?
Sure. I do think that the countercyclical buffer, which is part of what he's talking about, as well as the systemic risk buffer, will be decided over the course of this next year. I think it's also going to be very dependent each country by country. And our regulators, in speaking with folks throughout the past several years, are well aware of the fact that banks need certainty to be able to make decisions on capital, to make decisions on lending, and to make decisions on their business. So I do expect that we will have some certainty here over the course of the next 12 months.
One quick question before we go. Elizabeth Warren, she is for the time being going to be running the Consumer Financial Protection Agency. Is that going to hurt banks in a meaningful way?
I think we've seen a lot of change in the consumer businesses. There's probably some more change at the margin. I'm not sure it's going to be as much change as we've seen to date.
All right, Betsy, it is great to have you here. Betsy Graseck of Morgan Stanley. Her top picks: Bank of America, JP Morgan, Wells Fargo. She is bullish on banks and says consumer credit is the key.